how much risk do you actually need to take to generate real lasting wealth over time?
It sounds so simple, right?
Yeah, like there should be a formula for it. But the answer is, well, it's one of the greatest enduring mysteries of modern finance.
Exactly. It's the core challenge for every single investor, whether you're managing billions of dollars or just, starting your first retirement account.
And today, we're doing a deep dive right into the heart of that puzzle. We're talking about the equity risk premium, or the ERP.
We're looking at its history, how it's calculated, and what the future might hold.
Our sources for this are, they're unparalleled. We have pulled the absolute best minds in institutional finance.
We're talking people like Roger Ibbotson, Jeremy Siegel, the guys who basically define the historical data.
And heavy hitters like Robert Arnott, Cliff Asness, Andy Elmanin, they all gathered over 3 decades for the CFA Institute's Equity Risk Premium Forums to just battle this out.
And our mission for you is to give you a shortcut to understanding what truly drives long-term returns and, maybe more importantly, why your expectations have to change with the market.
We're going to unpack the single greatest engine of wealth creation in history. And if you want more analysis just like this, remember to subscribe to Money Mindset for deep dives into critical financial concepts.
But let's start with the history, because the numbers are they're shocking.
Okay, let's jump straight in. The astonishing results of just staying invested.
So the entire foundation for this whole debate, it really comes down to one set of data compiled by Roger Ibbotson and Rex Sinquefield. It's called the SBBI data: stocks, bonds, bills, and inflation.
And this is the one that gives you that explosive visual, that chart that everyone's seen.
Exactly. It shows the sheer power of long-term compounding. So get this. If you had invested $1 single in the U.S. stock market in 1926,
Just $1.
$1. By 2020, assuming you reinvested all your dividends, that dollar would have grown to nearly $11,000.
11,000. That's a compound annual return of what, 10.3% for almost a century.
Yeah. And that's just for large cap stocks. If you took on a little more risk, went into small cap stocks,
Okay.
that $1 becomes almost $42,000.
Wow. Okay, so that's an 11.9% return. The difference is just staggering.
And that gap, between 11,000 42,000, it's driven by just a 1.6% difference in the annual compound rate. That right there is the first huge lesson.
It has to be. And then you compare those huge numbers to the quote-unquote risk-free assets.
Right. So treasury bills, basically cash, that same dollar turns into a measly $22 over the same period.
$22. And inflation.
Inflation turned that dollar's buying power into $15. So cash barely kept up. The numbers make it painfully, undeniably clear.
Compounding requires staying invested over long periods. There's just no substitute for time in the market.
Absolutely. And that massive difference, that's what we call the realized equity risk premium. It's the reward you got for taking on the market's risk.
It's a difference between building wealth and just, treading water.
And this isn't just a U.S. thing. Elroy Dimson's global research confirms it. Across most markets, equities beat inflation, cash, and bonds by a huge margin over the long run.
Okay, but before we go global, we have to clear up something that I think confuses a lot of people. The difference between arithmetic and geometric returns.
Oh, this is absolutely essential. I mean, it's a huge source of confusion. With something volatile like stocks, the difference is massive.
So the arithmetic return is just the simple average, right?
Yeah.
Add up all the years and divide.
Exactly. For U.S. large stocks, that number is 12.2%.
Wait, okay, so if the average was 12.2, why did my wealth only compound at 10.3%? That seems like a big disconnect.
It is, and that's because the geometric or the compound return is the true measure of how your wealth actually accumulates over time. The arithmetic average is always higher if there's any volatility at all.
Can you give us a quick example?
Sure. Imagine a stock goes up 50% one year and down 50% the next.
Okay, so the arithmetic average is 0. 50 minus 50.
Right, but you haven't broken even. You started with $100, it went to $150, then it fell by 50%. So you're left with $75. You've actually lost 25% of your money.
Got it. So the geometric return is the one that actually reflects what's in your account. The arithmetic one is kind of a statistical illusion.
Well, it's used for other things, like calculating cost of capital. But for forecasting your own wealth, you have to use the lower geometric number.
Okay, so when we talk about the equity risk premium, or ERP, we're talking about the difference in those real compound returns.
Exactly. And historically in the U.S., that premium has been very, very high.
Which brings us to a huge problem for anyone trying to predict the future. This idea of American exceptionalism.
This is where you have to zoom out from the U.S. data, the Dimson, Marsh, and Staunton research, the DMS data. It looks at 23 markets all the way back to 1900.
Now, what does it show?
It shows the U.S. had a real premium over bonds of about 5.8%, which is huge.
Yeah.
But if you look at the world excluding the U.S.,
That's much lower.
much lower. The U.S. has been a true outlier. It has dominated the last century.
So the critical question for an investor today is why? Was it because U.S. companies were just fundamentally better? Or was it something else?
And Cliff Asness has a really sharp, almost controversial answer to this.
Okay.
He argues that nearly 100% of the U.S.'s outperformance over EFE, that's Europe, Australasia, and the Far East, comes down to one thing.
Not earnings.
No, valuation. Specifically, the U.S. market's Shiller-Cape-E ratio went much higher relative to everyone else.
Wait a minute, that completely changes the story.
It does.
So he's not saying U.S. companies had massively better earnings growth. He's saying investors just became willing to pay a dramatically higher price for those earnings.
That is the core of his argument. It's a confidence story. It's a story about the price multiple expanding. He says if it was all about superior earnings, you can maybe project that forward. But since it's almost entirely from this one-time revaluation...
You can't just assume that's going to happen again.
Exactly. It's a one-time leap. American exceptionalism, in his view, is a story about price, not just fundamentals.
And that's why Dimson warns everyone. Don't just extrapolate from the history of one winning country.
Right. Because if that massive revaluation event is in the rearview mirror, then using pure U.S. history is almost guaranteed to overestimate what future returns are going to look like.
Okay, so we've got these massive historical returns, but they come with a huge asterisk about U.S. outperformance. So how are we supposed to manage the risk that delivered them?
Well, that brings us right to modern portfolio theory, or MPT.
Markowitz and Sharp. The framework for optimizing risk and return through diversification.
Right. But it's built on some very specific assumptions, like that returns follow a normal bell curve distribution.
Which they don't always, especially in a crisis.
Exactly. Real-world returns have fat tails. Extreme events happen more often than the model predicts. Some critics have even said that applying these models without thinking about that makes them like quack remedies.
But even with those critiques, MPT gave us a critical concept: the two types of risk.
This is fundamental. You have to understand this. First, there's diversifiable risk. This is also called idiosyncratic risk.
So company-specific stuff, a bad CEO, a product recall.
Exactly. Things you can get rid of just by owning a lot of different stocks.
And then there's the one you can't get rid of.
Non-diversifiable risk, systematic risk, market risk. This is a risk of the whole system, a global recession, an interest rate shock, a pandemic.
You can't diversify that away.
No, and there's a mathematical reason for that, which they call the covariance wall.
Okay, that sounds pretty technical. Give us an analogy.
Think of it like this. Imagine you have a basket of apples. The idiosyncratic risk is that one of the apples is rotten. If you only have one apple, that's a huge risk.
But if you have 500 apples from different farms, the risk of one bad apple ruining your day is basically zero.
Right, you've diversified it away, but the systematic risk is the risk that you drop the entire basket.
And it doesn't matter how many apples you have if you drop the whole thing.
Precisely. The covariance wall is just the math behind that. As you add more and more stocks, your portfolio's risk doesn't go to zero. It just goes down to the level of the average covariance, how much they all move together. That's the market risk.
And the necessity of owning that whole basket is driven home by this mind-blowing finding from Hedrick Bessembinder.
Oh, this is one of my favorite pieces of research. It's so counterintuitive.
So what did he find?
He studied the market and found that only 4% of stocks, actually outperformed Treasury bills over his study period.
Wait, say that again? Only 4%?
Yes. The entire massive equity risk premium we talked about, that $42,000 from $1, it's all driven by a tiny, tiny handful of massive winners.
So 96% of stocks you could have picked either matched cash or, more likely, lost you money relative to cash.
Mm-hmm. Most stocks are average or poor performers. A few are spectacular. It's a power law distribution, not a normal one.
So what does this mean for the person who thinks they're a genius stock picker?
It means that you are statistically almost certainly going to fail. It highlights that a small number of financial choices determine most long-term outcomes. And the biggest choice isn't which stock to buy.
It's the choice to buy all of them.
Exactly. As Antti Ilmanen says, this data is a pallion to diversification, not for concentrated stock picking. The only way you guarantee you own the handful of winners is to own the entire haystack.
Because if you try to find the needle, you'll almost certainly miss it.
You will, and the human brain hates this idea. We hear about the Teslas and the Amazons, but we forget about the thousands of companies that just went to zero.
So diversification isn't just about playing defense and reducing risk. It's actually the only way to play offense and capture the upside.
It is, but even if we diversify, we still have that market risk, that systematic risk. And a lot of investors, especially younger ones, think they can beat that with time.
Right? The idea of time diversification. The thinking is, I have 40 years, so short-term volatility doesn't matter. It'll all average out.
It's a comforting thought, but it might be a fallacy. Pastor and Stambaugh really challenge this idea when you introduce something called parameter uncertainty.
Okay, parameter uncertainty. Let's break that down.
It just means we don't actually know the true underlying rules of the game. We don't know for sure what the future equity premium is going to be.
We're just guessing based on past data.
Exactly. And it's past data from a very exceptional period in a very exceptional country. If we knew for a fact that the ERP was going to be 6% a year forever, then yes, time would smooth out the bumps. But we don't know that.
So if the underlying parameter, the true expected return, could actually be 1% or 7% for the next 30 years, just having a longer time horizon doesn't get rid of that fundamental uncertainty.
Precisely. A longer time horizon just means you're exposed to that unknown for longer. So the idea that risk just magically declines with time needs to be taken with a huge grain of salt.
Which leads us right to the heart of the matter forecasting the future ERP.
The great mystery. And it's funny, historically you'd see these forecasts from all the big firms, and they always seem to cluster around 3 to 5%.
Yeah, like it was some kind of cosmological constant.
Martin Leibowitz points out that maybe 4% isn't a forecast, it's just a Goldilocks number. It's high enough to keep clients invested, but low enough not to seem crazy.
So how do you make a real defensible forecast?
Well, the most famous tool is the Shiller KP ratio, the cyclically adjusted price-to-earnings ratio.
And it's not a market timing tool, right? It tells you nothing about next week.
Absolutely not. But it is a very good estimator of long-term, like 10-year future returns.
And this is where we get the huge debate, the great mean reversion argument.
Mm-hmm.
On one side, you have someone like Robert Arnott. He has a simple framework. Your expected return is your dividend yield plus your earnings growth plus or minus any change in that KP valuation multiple.
And what does his model say today with KP so high?
He assumes that the KP ratio will revert halfway back to its long-term historical average of around 17.
And because we're so far above 17 now.
That creates a huge headwind. It means his forward return estimates are incredibly low, potentially a near zero ERP for the coming decade. He's basically shouting a warning from the rooftops.
That's a terrifying forecast for anyone planning for retirement. But not everyone agrees. Jeremy Siegel and A.T. Ilmanen, they push back hard on this.
They do. Their fundamental argument is that we shouldn't be reverting to that old average of 17. They think structural shifts in the economy mean we have a new, permanently higher equilibrium PE ratio. Maybe 20, maybe 22. What are those structural shifts?
A few things. Lower long-term real interest rates is a big one. But Siegel makes another fascinating point about the cost of investing itself.
How does that have a PE ratio?
Think about it. 100 years ago, the average PE was around 15. But back then, if you wanted to build a diversified portfolio, the transaction costs were astronomical. Brokerage commissions for every single trade.
It was incredibly expensive and difficult.
Right. Today, you can get a perfectly diversified cap-weighted portfolio in an index fund for, basically zero cost.
Mm-hmm.
So the trade-off for the investor is just vastly superior today. Since you get more bang for your buck, you should be willing to pay a structurally higher price for those same earnings.
So the market structure itself justifies a higher baseline PE. It's not a bubble, it's a new normal.
That's the argument. So you have these two camps. Arnott says multiples have to come down, so returns will be terrible.
Yep.
Siegel and Ilmanen say the new, higher multiple is justified, so returns will be lower than history, but not disastrous.
And the very existence of this huge debate between brilliant people proves a key point for us.
It does. Market cycles are unpredictable in both timing and direction. Trying to bet your life savings on which of these guys is right about mean reversion is a fool's game.
Let's move on to the growth part of that equation. There's another big controversy here. Dividends versus buybacks.
Right. Roger Ebbeson makes the case that buybacks have largely replaced dividends since a law change in the 80s made them more tax efficient.
So companies are still returning cash to shareholders, just in a different, more flexible way.
That's his view. A company can do a one-off buyback after a great quarter without setting an expectation, whereas cutting a dividend is seen as a huge negative signal.
But Robert Arnott calls this whole idea a mirage. Why?
Arnott's counterpoint is that when you look at the net effect across the whole market, things look very different. First, a huge chunk of those buybacks just go to offset the shares issued to executives for stock options.
So it's not actually reducing the share count, it's just preventing it from getting bigger.
In many cases, yes. But his bigger, more important critique is about dilution from what he calls new enterprise creation.
Okay, what does he mean by that?
This is a huge deal for anyone as a passive index fund. Arnott's research found that about 60% of the entire U.S. market cap today is made up of companies that didn't even exist 30 years ago.
60%? That's a massive amount of turnover. How is that dilutive?
It's subtle, but it's critical. When a huge new company like Tesla gets added to the S&P 500, what does your index fund have to do?
It has to buy Tesla to stay cap-weighted.
And to get the cash to buy Tesla, it has to sell a tiny slice of everything else it owns, all the established companies.
So you're constantly being forced to sell a little bit of your winners to buy the new thing.
Exactly. It's a constant, massive dilutive force on your existing holdings. If you just held a static portfolio of the S&P 500 from 30 years ago, you'd only own 40% of today's market. You'd have missed all that growth from the new companies.
So Arnott's argument is that this forced rebalancing is a hidden drag on passive returns that people aren't accounting for.
And it supports his overall thesis that real underlying growth is lower than we think, which means forward returns have to be lower too. It's a really powerful critique.
The final piece of this puzzle is just the current environment of low yields.
Yeah, NTL Mannon points out this paradox. The premium of stocks over bonds, the ERP itself, looks pretty normal. But both stocks and bonds are priced for historically low returns.
Everything is expensive compared to its own history.
Right. The whole curve has shifted down. And this brings us back to one of Arnott's most compelling models, what he calls the PE frown.
The PE frown. Help us visualize that.
Okay, imagine a map. On one axis, you have real interest rates. On the other, you have inflation. The map shows you what the PE ratio for the market should be in any given environment.
And what's the sweet spot?
The highest PE ratios, a KP of around 22 or 23, happen in a Goldilocks zone. Moderate inflation like 1 to 2%, and moderate real yields 2 to 4%.
And valuations get crushed when you move away from that sweet spot.
Exactly. Too much inflation, PEs collapse. Real yields get too high, bonds are too competitive, PEs collapse. But critically, PEs also fall when real yields get very low or negative.
Which is where we've been for a lot of the last decade.
At the time of the 2021 forum, the data was shocking. You had inflation over 5% and real yields near negative 4%.
And what does Arnott's historical map say the PE should be in that environment?
It says the Shiller PE should be around 11.
11. And where was the market actually trading?
Near a KP of 38.
Wow. So it was 3 times higher than the historical data suggested it should be.
It's a profound disconnect. The market was either pricing in a miraculous immediate return to that Goldilocks zone, or investors were just completely ignoring valuation.
And there's really only 2 ways for that gap to close. Either a massive, unexpected explosion in earnings, or a sharp drop in the PE ratio.
Which is why all eyes are on the Federal Reserve. If they can't steer the economy back to that sweet spot, Arnott's model suggests the threat of a major valuation correction is very real.
So we've got this complex debate on future returns. Let's shift to the human side of it. How do real investors actually behave in the face of all this uncertainty?
Mary Ida Compton, who consults for huge pension plans, nails the communication challenge. It's incredibly hard to tell clients to lower their expectations.
Especially after a year where the market went up 20%.
Exactly. The client sees that 20% gain and they think, great, I've got a cushion.
But that's the wrong way to think about it.
It's the exact wrong way. Her job is to tell them, don't see that as a windfall. See it as borrowing from future returns. Today's high valuation has to be paid for by tomorrow's lower returns. And this confirms that behavioral biases reliably lead to poor investment decisions.
And the data actually shows that trying to time the market based on those high valuations is a losing strategy.
Yeah, Dimson's research found that using a strategy based on the Shiller Cape, selling when stocks look expensive, actually lowers your long-term compound return in most countries.
Because you miss the big upswings, which often happen when things already look crazy expensive.
Right. Which leads to another behavioral flaw Martin Leibowitz talks about, inertia bias.
What does that look like in practice?
He says institutional allocations are amazingly stable over time. They start with a 60-40 stock bond mix, and they just mechanically rebalance back to it year after year.
Even if the underlying assumptions have totally changed.
Mm-mm.
Like even if bonds are yielding nothing and stocks are at a 38 cape.
Even then, the theory says if your stock allocation goes to 70%, you should sell 10%. But you could argue that if stocks are that expensive, maybe you should sell down to 50%.
But nobody wants to be the one to make that call.
Nobody. The career risk is too high. You stick with the herd. It's comfort in the status quo, even if the status quo is financially dangerous. It really shows how market cycles are unpredictable in both timing and direction, and our own inertia makes it worse.
This all ties into the paradox of momentum, right? The idea that what's gone up recently tends to keep going up.
And Cliff Asness points out there are two completely opposite behavioral theories for why this works.
And what are they?
The first is overreaction. The herd mentality kicks in, and investors push prices further and further away from fair value, creating a bubble.
Okay. And the second?
Underreaction. Good news comes out, but investors are too slow to price it in, so the price gradually drifts up towards fair value.
So momentum is either making things more irrational or it's fixing an inefficiency.
Yes. And Asness worries that in bubble-like times, it's the overreaction version that dominates, which means momentum investing is actually making the world a more dangerous place.
Which brings us to bubbles themselves. Robert Arnott has a really useful, practical definition of a bubble.
He does. It has two parts. First, the current price requires implausible assumptions to justify it with any kind of standard valuation model. Not impossible, but implausible.
And second,
The marginal buyer, the person setting the price at the margin, has zero interest in valuation models. They're buying because the price is going up.
and the ultimate warning against trying to be the hero and short a bubble is his story about Zimbabwe.
It's a classic. 2008, hyperinflation is destroying the currency. Shorting the stock market was the fundamentally correct long-term trade. But in the short term, the market went up 50-fold in dollar terms in about 6 weeks before it finally crashed. A hedge fund manager told him, "You would have been right, but you would be bankrupt."
A devastating lesson. It just proves that behavioral biases reliably lead to poor investment decisions, especially when you're trying to time these irrational manias.
So before we get to the actionable takeaways, there's this interesting conceptual debate. Is the equity premium even a risk premium?
Arnott argues it should be called a fear premium. Why the change?
He thinks if we had called it a fear premium from the start, a lot of the so-called market anomalies, like momentum or the preference for liquid assets, wouldn't seem anomalous at all. They'd just be expressions of collective psychology, of fear.
But Rajneesh Mehra has strong evidence that it really is a true risk premium.
He does. He contrasts it with other factors, like the size premium, the idea that small-cap stocks outperform.
Yeah.
That premium was widely documented around 1980, and as soon as everyone knew about it and funds were created to chase it, it basically disappeared. Same thing with the value premium after 1990.
So those were just temporary inefficiencies that got arbitraged away.
Arguably, yes. But the equity premium itself has persisted. Despite everyone knowing about it for a century, it hasn't gone away. And that persistence suggests it's a genuine reward for bearing that systematic, unavoidable market risk, the fear of total collapse.
So after all this complexity, what can you, the listener, actually do with this information? What are the actionable steps?
Well, the biggest takeaway is to translate all this complexity into simple, repeatable decisions that remove your emotions from the equation. Jeremy Siegel makes the point that the best deal in financial history is available right now. A fully diversified portfolio for almost zero cost.
You couldn't do that 100 years ago.
Not even close. So if we know the biggest mistakes are trying to time the market and picking individual stocks,
The solution has to be structural.
it has to be. You leverage those cheap passive vehicles and you set it and forget it. This is where you see that automation reduces the number of decisions vulnerable to human error. It locks you into the winning strategy.
So instead of worrying about whether Arnott or Siegel is right, you just automate your savings and your allocation.
That's the discipline. And when expected returns on everything are low, the only rational response is to lower your own expectations and, frankly, increase your savings rate. This is where we see that lifestyle inflation reduces the percentage of income saved, and in a low return world, that's a killer.
And in terms of allocation, Mary Compton's advice seems critical now, given how much of the U.S. outperformance came from that valuation jump.
You have to diversify internationally. The U.S. will inevitably underperform at some point. A globally diversified portfolio is no longer optional, it's essential.
So the playbook is lower your expectations, save more, diversify globally, and automate everything so your own behavior doesn't sabotage you.
That's it. The alternative is trying to time the market, trying to pick the 4% of winners, and letting your fear drive your decisions. And that's a recipe for long-term failure.
Okay, so to wrap this up, we've gone through the incredible power of long-term compounding, the absolute necessity of diversification, and the sheer futility of trying to time the market.
And it's humbling to look back. The consensus forecast for the ERP over the last couple of decades was always in that cautious 3 to 5% range.
Yet the actual realized premium from 2011 to 2021 was a massive 11.7%. The experts were way off.
Which just goes to show how unpredictable this all is. And with bond yields where they are today, near historic lows, often negative in real terms.
The question we have to leave you with is this. Knowing you can't count on history repeating itself, how much lower are you willing to set your expectations for the future ERP? And if bonds aren't a safe hedge anymore, what is?
And here's a final provocative thought for you to chew on. It comes from William Goetzmann's research on a French water mill company that had publicly traded shares from 1372 until 1946.
574 years of data. That's incredible.
It is, and it allows us to look at the ERP across periods of war, plague, revolution. And what's amazing is that the long-term real return on U.S. stocks since 1802 has been remarkably stable, right around 6.8%.
So if the ERP is really a fear premium, like Arnott says, how can that number be so stable across centuries?
Exactly. Can you really say that the fear felt by an investor in 19th century America with no regulation and constant banking panics was the same as the fear felt by a medieval merchant buying a share in a French mill in the 1400s?
It seems impossible. Goetzmann's work suggests that maybe investors have always been more rational than we think, pricing in the value of future dividends. The stability of that 6.8% premium across such wildly different worlds might be the biggest mystery of all. It's as if the one constant is the fear of total systemic collapse.